Right, so we are going to look at this question called the Hraxin, and this one is coming from investment appraisal. Basically, this is where, if you have been looking at the videos, where we normally calculate net present value and determine whether we should invest in a project or not. That being the major topic of coverage here. But of course, we have other things like internal rate of return and payback period and the like. So in this one, they are asking us to calculate the expected net present value and comment on the financial acceptability for 9 marks. And then they want you to discuss sensitivity analysis and if it will assist Hraxin in assessing the risk of the investment project. And finally, they want you to describe the process that would be undertaken to decide whether to lease or buy. So here we have a short-term decision-making question where you have to decide whether to lease or buy. A very common question as well. So when you look at what is given to us, they're saying that Hraxin is appraising an investment project which has an expected life of 4 years and which will not be repeated. Initial investment payable at the start of the first year, 5 million. Scrap value, 500,000 at the end of the 4 years. There's some uncertainty about what price that can be charged for the unit produced by the investment project, as this is expected to depend on the future state of the economy. So they are forecasting selling prices and their probabilities. There is a weak chance if the economy is weak, medium or strong. So the chance of the economy is given to you, and then the expected selling price based on the economy. 25 if the economy is weak, medium if it's do started, and if it's strong, we'll do 35. So the selling prices will be subject to annual inflation of 4% per year, regardless of which economic state prevails in the future. So we have forecast sales and production volumes, total nominal variable costs. Here we have been given these forecasts. So we have the production units and then the nominal variable cost. Then they are telling us that in order incremental overheads of 400,000 per year in current price times will arise as a result of undertaking the investment project. A large proportion of the overheads relate to energy costs, which are to increase sharply in the future because of energy supply. So inflation is going to be 10% per year. The initial investment will attract a taxable depreciation on straight line basis over the 4-year period, and the rate of corporation tax is 30%. Liabilities are paid in the year in which they arise. And we have been using nominal after-tax discount rate of 11%. Okay. So, now this is a typical question, a typical NPV question. The only difference really for this one that you won't find in most questions, here they are also, okay, it's not that you not find it, but a typical question would not have uncertainty analysis. But in here we have uncertainty analysis, so that's the only thing that may be a bit unique about this question. If you look at the questions that are in the kit and the past papers on the same. So normally you attempt them by first of all setting up a spreadsheet in this where you have, remember for section C numbers you have been given based on the question. So in this case, they will have given a spreadsheet. So we need to find the years. Maybe you can first label the question. Hraxin. So we answer in the first part, so we have to put the years. So the years are 4 years. And then you need to know whether tax is paid in the same year. It is paid in the same year, the year in which it arises. So you won't need the fifth year. Usually, if it's paid 1 year in arrears, then you need to put here another year to calculate for you. So with NPV questions, of course, you do need to know what's the revenue and then the costs. And the costs, you can have variable costs, then you can have fixed costs. So sometimes they can give you these two as a contribution. Now here we know they gave us that revenue is anticipated to be either 25, 30, or 35 based on the future economic state. So to get the expected, so we need a working here for this revenue. So if I'm rephrasing it like that, then I can come here and say working one revenue. So I can get this table, economic state, probability, revenue. That I don't have to. So economic state, if it's weak, then there is medium, strong. So probability here is 35, 50, 15. Okay, and then the revenue, we have 25 per unit, 30 and 35. So what we normally do in this case is get the weighted average. So the expected revenue is going to be expected selling price, actually. Selling price. So expected selling price. Now we need to get a weighted average. So how do you get that? Basically multiply the probabilities by the selling price, and then you add them together. Okay. It gives us about 29. Yeah, 29. So this is expected selling price. But this selling price, this is going to incur inflation of 4%. So now the trick is knowing whether that 29 that we have got is going to be the one for the first year. Okay, so how do you know whether it is the one for the first year? So this 29, because they have not told us that it's for next year, it is what they're expecting. So we are going to assume that it is not yet inflated. So we inflate it by 4%. So you have here the years. 1, 2, 3, 4. Then you can have the selling price. And the selling price, as we said, we are going to have this amount inflated by 4%. Okay, so for the first year, it will be 30.16, and then it will increase. Okay, so here, this one is going to be fixed. Okay, so that's the selling price. So then we have the units. 150,000, 250, 400, and 300. Okay, so we have our units. So we can get the revenue as a product of the selling price times the units. Okay, so we have been given some amounts in thousands. You can choose to work in thousands, or you can choose to work in dollars, but you have to mention it here. Because if you're working in thousands, that means that when it comes to the revenues, you are going to bring this revenue in thousands. So those are our revenues. Then the variable costs have been given to us here, and they have been given to us in nominal terms. So remember, what we have are the nominal variable costs. So we need to know that we are going to have to remember, when you are dealing with inflation, you have to decide whether you are using a real rate or a nominal rate. So a nominal rate means you are looking at it in money terms. Okay? And then the real rate means you are looking at it in real terms. The real terms means that you have already you are using the amount before inflation. So since we are doing nominal, so we are going to use values that are being inflated. That's why we have our revenue here inflated. Then since the variable costs have been given to us the same, we are going to just take them 2385 for 200. $7,080 and 5,730. So we have our variable costs. Now for the fixed costs. So do we have fixed costs? We have overheads. So these are the ones that we are going to use. Incremental overheads. So let's call them incremental overheads. So for incremental overheads, say they're going to be 400,000 in current price terms, and they'll rate energy costs, which are expected to increase. So there's going to have 10% inflation. So means that this 400,000, so we can work that one out here. We don't have to make a working for it, because it's 400 multiplied by 1 plus 10% power 1. That is for the first year. Then you you drag it to get the one for the other years. So those are the incremental overheads. So from here, we can now usually depends on how you deal with this, because in accounting you put depreciation here. So you can put depreciation here and work it out, or you can do it a different way where you put tax benefits, but you can look at the solutions. Maybe they have the different methods, but I prefer to do the one where you put depreciation here. And here they told us that depreciation is going to be on a straight line basis over the 4-year period. So, and that is usually on the purchase price or the initial investment. So initial investment is 5 million. So 5 million initial investment, but it has scrap value of 500,000. So it means that we are going to have depreciation of 5 million So since we're working in thousands, minus 500,000 divided by 4. That's the depreciation per year. So from here, we can now calculate our tax. Okay, these are our cash flows. Then we put tax. In tax, they told us it was at 30%. So 30% of our cash flows. Now, as soon as you calculate this tax, you have to add back the depreciation. Because it's not a cash flow, we just used it to basically get a figure to use to calculate tax on. So you have to add it back. Okay? So after doing that, now we can bring other cash flows that may follow here. So usually you can have things like working capital, but here I think we don't have any. We just bring the cost, which is 5 million, and the scrap, which is 500,000. And you can put these ones on the same line, or you can separate them. That depends on what you prefer. But then from here, then we can get our total cash flows. Okay, before I proceed, I want to know, is this clear up to now?
It's clear, but I would want to know if the question was asking for nominal. I mean for real.
If the question was asking for real. So, now
Yes.
this question is not asking for real, because here they have told us that they have even given us a nominal after-tax discount rate of 11% per year. So we have to inflate everything to get it to money terms or nominal terms. If the question had been set and wanted you to, sometimes they don't restrict you, but you look at what is given to you as the information. Now, if they give you everything inflated on this, like using the same rate, then chances are you can use either of the two. If you have the inflation rate, you can inflate and you get the nominal rate. But if you are if you are given like how here everything has a different interest rate, then that means that you probably may need to do it using the nominal rate. You can also do it using the real rate, but here we don't have the inflation, general inflation, so we can't really even calculate it. Okay, so here we may be only restricted to using the nominal rate. So now, after I have our cash flows, then we can now go to the discount factor. Now, this discount factor is in this case, 11% nominal rate. So you can either do it at 11%. So usually you can go to the tables for this. You have tables, but most likely you would want to use the calculation in this case because it makes it faster, but it also avoids you copying wrong figures. You are in a rush. Okay, you just have to get yourself used to using that discount factor. So after you get the discount factor, you can get the present value as the product of the cash flow and the discount factor. Then you get your NPV as the sum of your present values. Okay? Now, you can do all this, or you can use the NPV formula. The formula is there in the spreadsheet that they give you. It can work in the exam, but you have to know the formula. So the formula is NPV. Okay, then you give it the rate 11%. Then you give it cash flows from year one. So from year one, close bracket, and then you subtract the initial investment. But because it is negative, I'm using here add, and it gives you the same exact answer. And it doesn't matter if you use the formula or if you do all this, the marks stay the same. Okay, so you may benefit from knowing this formula so that you calculate very fast and get your NPV. Now, so the question asked us to calculate and comment on acceptability. So we say since the NPV is positive, the project should be accepted. However, we need to do a sensitivity to know if the selling price is 25 due to a weak market, whether the project will remain viable. And actually, in this case, since we are using Excel, we can determine that. All we need to do is to come here and put 25. And you see that it is still positive. It gives us 1229. But the net present value has been reduced, so it means that most likely the profitability has reduced, but we are still profitable. Okay, so that is the first part of the question. And then they ask you to discuss if sensitivity analysis will assist in assessing the risk. So here what you need to discuss is what is sensitivity analysis. Okay, I actually have sort of touched it a little bit here, but sensitivity analysis is used to determine how a change, yes, so sensitivity analysis is used to determine how a change in a variable, so here I can say uncertain parameter, can affect the profitability of the project. Okay, that's what sensitivity analysis usually does. And in this case, they didn't tell us to calculate it. So you don't have to calculate it, but you just have to explain how it affects. But you have to know how to calculate it, because most questions in this case will ask you to calculate it, sensitivity for the different variables. And the variables that we are looking at here are the revenue, okay, the variable cost, the overheads, even you can look at the tax rate, the discount rate. All those things are uncertain. Okay, so you can say that all the parameters in the NPV formula are subject to change as their forecasts. Thus, now this question, you need to make sure I talk about Hraxin. Hraxin needs to know which of them are most likely to derail the project. Okay, so then you can say in this case, so remember these are 6 marks, so you're going to need to write something worth 6 marks. So you need to make good points. So now, so one of the things that you need to figure out in this case is that they are indirectly asking you, given that we have this uncertainty here regarding the economic state, if we do sensitivity analysis, are we going to actually be able to cater for this problem? Now, that is not actually true. So you say sensitivity analysis only tells you how sensitive your project is to a variable, but you will not attach probabilities on that variable occurring, and thus cannot be used to de-risk the future economic growth and the selling price per unit. Okay, so you get the solution and look at how that has been like enlarged in terms of explanation, but keep in mind, as we said, only look out for those places where they have highlighted them in gray, because they have given you much and they don't expect you to write all of it. But at least we know from what we have done that we know that the the sensitivity analysis is not going to help us with this, but it can at least tell us which parameters are uncertain, and it can assist us to get more information on those parameters so that we are certain about them. Now, so here they are telling us to describe what we do when you are going to decide whether to lease or buy. Now here they are asking you to use your calculation, but in this case, describe what you would do if the question had come. So the question can come and they give you the option to lease or the option to buy. So what would you do to determine that? So step 1, calculate NPV from buying the product. Okay, in this case, the asset. The asset, then you can say the money used to buy will most certainly be borrowed. So there will be borrowing costs, tax savings from this borrowing. Okay, step 2. Calculate the NPV from leasing the asset. The lease arrangement will most likely not result into borrowing. So there will be a saving from the would-be interest. Okay. Then step 3, compare because remember when you are buying or leasing, usually the NPV is going to be negative. So compare the NPV from the two options. The one which costs less in NPV terms is the option to take. So those are the steps that you take to lease or buy. So again, I mentioned that you can go and look at the solution and basically see how much more they have written. One important thing when you are looking at lease or buy is that costs common to both options may be left out. They are not relevant costs in this case. So do you know why we do that? If we are making a decision between two things, then whatever is common to them is not a deciding factor. Let's say I'm asking you to choose between buying land and buying a car. If those two things cost the same amount of money, then if I need to go and take out a loan for both, that is not relevant for my decision because they cost the same. So I will have to start with the money that I borrow either way. However, then you start looking at other factors like the car. After you buy it, you need to fuel it, you need to do this and that. Then those are relevant costs now for the car. Then also for the land, you pick the costs that are relevant for the land, and that's how you compare. But anything that is common to both, you don't actually worry about it because it is really not going to it's going to balance out either way. So that's it for this question, Hraxin. And as I mentioned, this is a typical NPV question. Of course, for NPV questions, what you mostly find, some of the things that we may not have seen here, is working capital. Okay, working capital is one of those things that you find. Inflation we have found, although we have not seen the one where we're using real terms, which I believe the examples that I've provided to you, so you can look at some of those. And then also sometimes when you give in tax in arrears, and as well depreciation, where we use reducing balance. Because this one of straight line is usually very easy, but reducing balance has some trick to it that you need to understand. What else? I believe for our level, that's mostly what they ask. Then when you go further on, they start also asking you about things like using the money from a different currency for the project, and therefore do foreign exchange and all that. But at least for our level here, we're not going to worry about that. So that is Hraxin. I don't know if there are questions before I proceed.
Not for now, but
Mm.
I'm just worried about the theoretical bit of the parts that come in sections. Sometimes I worry I'll find some surprise questions, and I'm trying to read through the theory, but things are so much, and I was wondering if there are some tips of some topics that are normally accompany this section, big calculative questions. I'll appreciate.
Maybe what I can tell you about those questions is that the thing is you can't spot with this syllabus. So what you do, that's the reason as why we were suggesting that you have to look at the entire kit. So of course the note that I provided you, uh the ones that are in the videos, those videos. I don't know if I gave you the notes themselves, or you just have the textbooks.
You didn't share notes, but I'm trying to read through the Kaplan as I also read through the BPP and also the ACCA website.
Okay, yeah, okay, that is okay. Although it seems that you are using so much in terms of the material to read, so that is why you may see that time is not going to be very like available for you to read everything. Uh, so what I would advise is to stick to like Kaplan and then the SCA portal, where the study hub, okay? Because the study hub has been developed based on the syllabus we'll be looking at, so it tries to give you only what you need. Okay, so you can use the Kaplan and the study hub, but also I'll share with you the notes that are in the videos that you watched, because the content there is a little bit shallower, so it can give you a broad understanding. And now what happens is that every time you do a question and you find the section C component, which is theoretical, and you didn't know it, summarize it in the text in the notebook where you make your notes. You summarize it there so that as time goes on, when you keep doing that, you start seeing repetitions of some of those questions, and then even your breadth of understanding increases, so that by the time you do the exam, you have looked at so many of these. That's one of the easiest ways to grasp this information, because what I used to do when I was doing the exam, of course, I think I didn't have so much I was doing then. So I would get the entire kit, the entire study text, and read it, the whole of it. And then after reading the whole of it, I would now do the questions from the kit. But that turns out that you read a lot. Okay, it helps that you understand, of course, a lot, but the time that you have may not allow you to do the same. But it's very important that you do so, because section A, B, and now the theory parts of section C, some of them hinge on the fact that you know the theory behind the calculations. So stick to Kaplan and the study hub. Then I'll share with you also those notes. If you say I've not shared and I've forgotten, you can remind me. Okay. So let us do also this question, which is this one is called the Hebac. So same content being asked. So it's just cementing the idea that we have just looked at. They want to capture net present value of investment in nominal terms. Here they have told you nominal terms. So that means that they may have given you different rates. And I can see from here that they gave us a nominal cost of capital and a real cost of capital. But here they have told us to use nominal terms. So this is one of those places where you have to follow instructions. If you use the real terms, you will lose some marks. Okay, not all 12, but definitely you probably lose 2 marks or 3. So then they also want you to comment, of course, on the financial stability, as well discuss how the capital asset pricing model can assist Hebac in making better investment decisions with respect to new products launch. This one is for 8 marks, so you need to explain very well what is capital asset pricing model, why can't we use the weighted average cost of capital for new product launch, and how does it help in pricing better. So we shall go through that part. Then when you go through, they're saying that Hebac is preparing a launch of a new product which is outside the current business operations. So this is one of the points that we are going to have to make. Because remember, when you are doing this, you need to be as specific as you can. And in this case, specificity on Hebac using capital pricing model is based on the fact that they want to launch a new product which is different from their operations. So they have done research and marketing test at a cost of 500,000. So this has already been spent, so it is not relevant. You need to point out that that cost is not relevant, because the examiner wants to know why you didn't use it. So, and they expect their product to be successful. So they want to charge a lower selling price initially and then increase the selling price, assuming that the new product will establish itself in the market. So these are the sales that have been forecast, and selling prices and variable costs. And they're saying that the amounts given here are in current price terms. Okay? Before doing forecasting for selling price of 4% inflation and variable cost of 5% inflation per year. Then we have incremental fixed costs of 500,000 per year. in current price terms, and those that are producing the new product. And then fixed cost inflation is 8%. Then the initial investment cost of production for the new product is 20.5 million, payable at the start of the first year of production. Production will cease at the end of the 4 years because the new product is expected to have become obsolete. And they would sell the production equipment for about 125,000 in future value terms. Now this one is in future value terms. So it means do not try to inflate it. Okay, then working capital here of 1.5 million will be asked at the start of the first year of the preparation. There is 6% inflation per year, and all working capital will be recovered at the end of the 4 years. Tax is payable 20% in the year in which it arises. There is depreciation of 25%, reducing balance, adjusted in the final year of operation for balancing allowance or balancing charge. So we shall see how we handle that. Then a bank currently has a nominal after tax weighted after cost of capital of 12% and a real one of 8.5. So we are supposed to use nominal. So let us set up everything to work in nominal terms. Okay, so of course you start with the years like we saw. How many years? 4 years in this case. So of course you would have the revenue, variable costs, fixed costs. Then you would have taxable depreciation. So for the revenue, they are saying we need the working because we have to inflate. So we can have this one called working 1. So we shall have the years. Then we shall have the selling price. Now the selling price is given as 15, but it's going to be inflated at 4%. So we shall have 15 multiplied by 1.04 power 1. Then that one goes all the way to the 4th year. The units are 200,000, 800,000, 900,000, and 400,000. So the revenue is the product of these two. Okay, so you can again here work in thousands. So that means that it will be this revenue divided by 1,000. Then the variable costs are 39. So even here we shall need a working. So working 2. Okay, so you can actually copy some of these things. We can come and put here the variable costs per unit. So the first one is 9. Oh, it's 9 everywhere. So that is a good thing, because that means that we just have to change this one to 9 and grow it by 5%. So that is the variable cost. And the units are still there, so these are now the variable costs. So that means that you bring these ones. So after doing the variable costs, then you do the fixed costs. So those ones, they said that they are going to be 500,000 in current price terms, and they will grow by 8%. So that means that you have 500 multiplied by 1.08 power 1. Okay, so you have your variable cost, your fixed costs, then tax. So this one also needs a working. So working 3, taxable depreciation. So here you start from year 1. So the cost is what? Because remember, we use the cost 2.5 million. So let's say we are working here again in thousands, or we can work here in the same currency, and then we just carry it this side. So 2.5 million. Then you subtract depreciation, which is okay. I remember seeing, okay, 25%. So 25% of the cost. So what remains is 1.87. That's for year 1. Then you do it for year 2. You are now left with 1.406. And then you do it for year 3. Now I have to 1.054. Now in year 4, which is the last year, you look at the scrap. Now the scrap, 125,000. So if it's still carrying at 1 million and the scrap is 125,000, then the difference between that, so because you're sort of like making a profit, okay? So we shall calculate what we call this whole amount will be a balancing charge. So don't forget that we are working in thousands, so divide by 1,000. or it's better to just use the workings in the same accuracy as you want to work with. Okay, so that's the depreciation. Then you can now get the taxable cash flows. Then you get the tax. The tax is at 20%. Then you add back the depreciation. Okay, so after you do that, then now you bring working capital. So working capital, they said that we shall need 1.5 million at the beginning of the year. So that is going to need another working. So working for so here we have years 0, 1, 2, 3, 4. Working capital needed. So they said that we need 1.5. At the start of the first year, but we shall inflate by 6%. So it means that we are going to actually get this amount multiplied by 6%. Then we can drag it. So these are 4 years, 1, 2, 3, 4. Then the changes, of course, here you have the entire amount because that's the first time, but then the second time you just need the difference between that and the one you have. So that is 900,000. That's 945. That's 100. That's 101. And then in the fourth year, you get all of it back. So that's what they told us is going to happen. So for working capital, we are going to need so working capital is there. And then we don't have any other thing apart from bringing the costs. And the costs 2.5 and 125. Okay, so from there we can get our total cash flows. Then you can get NPV. And as I said, you need to know the formula because in this case, we don't have to waste time. Now here you need to bring the nominal tax rate of 12%. Then cash flows from year 1. And then you subtract the initial investment. Now, since NPV is positive, we accept the project. Okay. So I'm hoping now you are going to be very good with calculating NPV. I'm hoping that should not be a problem for you.
Yes, yes, but I think I'm lacking in working capital, especially to deal with inventory. I was trying out some numbers and then failing on the way.
The working capital to do with inventory. But are you talking about FM or PM?
Financial management.
You're referring to the working capital management.
No, I was okay. I was trying out number. There is 272 Dastico and Candico of 274. Of course, trying out myself as I look at the answers on the kit, but I was getting lost on the way.
Okay. What now that you see, there is a section called working capital, a very big section. And then, so that is the one where you have working capital, where you deal with inventory. So I understand your question. We shall do a question on it. Which question were you doing? Can you WhatsApp it to me so that we do it tomorrow?
Okay.
Yes. So, but for this one, NPV, that's a different story. It doesn't have dealing with inventory for working capital at sea. Usually they tell you that you have working capital of this much. So, second question. Second question is just asking us to discuss how capital asset pricing model will help Hebac make a better investment decision. So, now, as I said, you're going to get the solution and get more of how to write this one and also summarize it in your notebook, like we said. And I'm just going to explain to you what capital asset pricing model is. So now, for you to understand it better, you need to first of all realize that when you use for a new investment like the one we are doing here, the one Hebac is doing, okay? Hebac can only use the weighted average cost of capital if, and these are the two scenarios where they use it. One, the gearing of the company is not going to be affected by the new investment. Remember when we borrow or use by the financing for the new investment. Okay, so the cost of capital is not going to, the gearing is not going to change. And another thing, the business risk of the new investment is the same as the business risk for the company. So, as long as those two things hold, you can use work. Now, For new investments, seldom do these factors be both true. So in that case, capital asset pricing model can be used. Okay, first of all, capital asset pricing model, the formula you can find it's there in your formula sheet when you are doing the exam. But what it does, it says that the cost of capital is equal to the risk-free rate plus the beta multiplied by the risk premium. That's capital asset pricing model. So it's used to get a cost of capital that represents how risky the project is, or a project is relative to the risk-free rate, and makes use of the beta, or we can call it the equity beta. So that's how it does. So by doing this, we can get a proxy company or a proxy beta for a company with the same level of business risk as the project we want, and apply our project gearing, thereby adjusting for both the change in gearing and business risk. Okay, like I said, 8 marks. This is sufficient for those 8 marks. But you can always also go back to the answer. And in this case, let's actually go there together. So Hebac, so they explain to you here, as I told you when you are looking at the solution, this part is also important. It kind of tells you what is expected. Like part 1 is easy, it's typical, blah, blah. Then they calculate. Okay. So so here they come and explain work. Okay. Work is used if the business risk and financial risk are similar, and the financial risk of the business. But if it differs, then you can't use it. So cost of capital gives a project-specific discount rate. Equity beta, whose operations are similar to those of the investment, to reflect the systematic business risk. Then you ungear it to remove the effect of the gearing. Then you apply our gearing. Okay. So you notice that I have put, they have worded it differently, but they are saying the things that I've written down there. So you read through them and make them make sense for you. And then also in this case, they gave you the marking scheme, but they didn't give you the examiner's remarks. So perhaps maybe they didn't remark on that, because I told you it's important when you do the question to see what the examiner talked about. Like here in this question. This question is called, Vixen. Okay, so for some of the questions, they have these examiner's comments that you need to read, and you see what most people made mistakes when they're calculating and what they expect of you. Okay, so I think I don't know if you have any questions for me right now.
Not for now.
Okay, so WhatsApp me the name of that question so that tomorrow I don't forget and we do a different one. So we'll do it tomorrow. And then we also see another question that may also be dealing with something in working capital. So have a good night and then see you tomorrow.
Good night too, and thank you.
Okay.